Okay, so we're going to get started here. So this is a 0DTE trade. And the title here is How to Make Profits with 0DTE, 0DTE SPX credit spreads. All right. So we're going to get right into it here and let's go. Okay, so what can you expect? I'm going to show you how you can make consistent returns monthly based on margin capital at risk by adjusting trades without taking large losses and making profitable returns. Okay, and what you'll learn here is how I went from taking 0DTE 3x losses, which means the 3x losses means that you receive a premium, right? And let's say it's 50 cents, and then you take a stop loss for 150, and that's how you close the trade. And so we made some changes with that, and we'll be talking about that. So how to identify strikes and strike prices you'll be using to increase your chances of profitability, how best to mitigate a trade that's threatened, what are your capital requirements to manage in the money, out of the money, credit spreads, and the best time to widen spreads to gain an edge in the position. So if you stick with me to the end, we have a bonus, and it's a good one, so you'll like it. Just want to ask you to turn off all the distractions here. Want to focus on, we have a lot of stuff to cover. I'm going to try to get through it. Some of it's a little technical, but hopefully you can go back and refresh and listen to it again. I'm going to answer all your questions, but I'm just going to ask if you could just hold it till the end, and I will go back and answer all your questions, okay? So question one, what is the reason that you're here? Are you interested in learning new strategies that you'll take your trading performance to the next level so you can leave your 9-to-5 job away? Reason two, you've seen, heard about, read about, and others making money, and you know you can do it too, but you're just not seeing your account grow fast enough. And the reason three is you've tried different trading strategies that you've thought, okay, this is it, only to discover that it's not getting you to where you want to get to, okay? So let me see if you have a show of hands here real quick, where you're most affiliated to, interested in learning new strategies, desire to see your account grow, or finding the right strategy that provides that consistent trading result. Any hands here? Virtual hands? AI hands? Three, all three. Yep, that was me. For more than you would want to know. Yep, 333. Okay, cool. Yep. Interested in 0DTE? Great. Conservative strategy. Got it. Yep. And it's all about managing, right? Managing the risk. Okay. All right. Real quick. I live in Puerto Rico, and this is my wife, and we've been here about 4 years now. My kid's in the middle, 5 kids, and MBA program on the right with my parents a long time ago. So regular guy, loves to trade and loves to teach. So let's get going. So first of all, really important for us to have a good mindset. So let's imagine now how it would feel like if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. Number two, becoming the trader that no longer takes large losses but consistently trades according to a proven trade plan. That's really important. That's profitable over time, allowing you to grow your account month over month. Okay, so now we got the right mindset, right? So let's talk about what is an SPX credit spread. So a credit spread, it's a vertical, okay, one option type over another. The credit spread is a combination of 2 puts or 2 calls, where the put or call that is sold is more expensive than the put or call that is bought. And the reason for that is that's how you get a credit into your account, Okay, so when you place this trade, you're actually getting a credit for the position at first, and it's actually your max gain as well. That's your max gain, and not your max loss though. Selling, you're selling actually in this case the 40-50 and buying the 40-40. Okay, so the put, one put is higher than the other, and the put that is higher is less expensive than the put. I'm sorry, the put that is higher is more expensive than the put that is lower, and that's how you receive the credit. So this is considered a high probability trade, and you'll hear that out there quite a bit for different types of trades. Okay, so let's talk about the risk reward, which is not great for SPX. This is called a bull credit spread when it's with puts. The risk reward is $1,000 to put on this trade for a 10 wide spread. So you can put 5 points, 10 points, et cetera. Each point is $500. And in this case, if you receive a premium of $550, that is basically your margin requirement minus the $50. So it's actually $950. And that's how it works. Okay. So why it's a high probability trade? Because the rate of decay is always happening with options. All right. When you buy an option, it's going against you. When you sell an option, it's in your favor. Okay, because it's decaying in your favor. So from first 68 days to 33 days, the rate of decay is 34%. From 33 days to 5, it's 57%, and from 5 days to expiration, it's 100%. Okay. We have profitability factors that we use. Implied volatility is the #1 thing for 0DTE. And so the ideal setup is when volatility is moving higher and when you place the trade, and after you place the trade, volatility moves lower. So and sometimes that doesn't happen, but that's the ideal condition. Okay. Theta is one of the Greeks, and it measures the rate of decline in the value of the option. So that's really, really important for you to know and where that comes from. And profitability #3 is the market direction. So if you're trading, let's say, a put spread, which is a bullish position, you want the market to go up. If you're trading a call position, a call vertical, it's a bearish position, and you want the market to go down. So that's how it works. Okay. So let's talk a little bit about risk management. Always trade with a plan. #1. #2, determine your max loss and risk reward. You don't want to trade more than 20% of your margin with these types of trades, just because you need to have cash. And when you roll the trade, it does cost sometimes. Okay. And we'll talk about that. Don't allow more than 2% loss on your trade. And for highly trending markets, you want to position your trade so they follow the trend. That's ideal. And the size of your trades need to be respectful in terms of your emotions. Okay, so the bigger you're trading, the more you're going to feel emotionally risked out, I guess. In that. And so I always say trade small, trade often, especially when you're trading a new trade, so that it doesn't kill you if you have to take a loss. Okay. So pre-market routine, I always review areas of support and resistance. Those are really the best technical things that you can use, right, to manage your trades, and where the market's going and where it's stopping, et cetera, et cetera. You always want to review the dollar, and the dollar has been moving up lately in the past few days quite a bit, but the market's been going up. It's usually the other way around. When the dollar goes up, the market tends to go down, with the market going up, it's probably a very bullish sign here. Okay, So review the 10-year Treasury. The Treasury markets have a competition with the market, with the equity market. So where when interest rates go high, people will want to buy treasuries, right? Because it's risk-free money, basically. And so you wanna understand that. Okay. Review ES futures trending market, just because the market for futures is always moving, but not the SPX. And so you want to take the cue from the ES futures, okay, that trade overnight 6 days a week. Review VIX level and the VIX is the volatility index for the S&P 500, so that is important. And determine when credit spread positions you want to place. You want to save those in your account, and then make sure that you're able to get in very, very quickly. And that's because when I trade 0DTE, I trade it right at the beginning of the market open, and we'll talk more about that as well. Okay. Post-market routine: determine if rules were broken and why. Determine if the risk was within acceptable levels. You always want to trade with a trade journal. Determine if losses are within acceptable ranges, and tweaks and adjustments you should always be making if you need to your trading plan. And again, you want to update your trade journal. Okay. All right. So pattern day trader is very, very important when you're trading 0DTE. If you have an account that's lower than 25,000, you are subject to PDT restrictions. And what can happen? Well, what is it first, right? The buying and selling, and the selling and buying of a security on the same day that's initiated, and doing that 3 times within a 5-day period. So you can do that. You can make 3 trades in that 5-day period, but if you make a 4th one, you'll get restricted and possibly just being able to liquidate your account. Okay. So it's very, very important that you do that. So be cognizant of that. Ways to avoid it is limit your trades to 1 day, 3 days a week. Manage trades from multiple accounts. Trade wider iron condors if you're going to do that. And you can also trade ES future spreads that are not subject to PDT restrictions. And I don't know why, there's a difference with that. And one day somebody will wake up and realize it. But in any case, because trading options on futures are pretty much identical as SPX. So, but one you get restricted on, the other you don't. Okay, so let's get into this now. Okay, so we're going to be talking about managing SPX 0DTE trades. Okay, and the first part is going to be placing them, but we're going to be looking at out of the money, in the money, same strikes, lower strikes, and widening on the spreads. Okay, so we've got a lot of things to go through. So let's talk about entry first. Okay, so I always get in to the position between 1 to 10 minutes using a 5 to 30 wide spread. I trade 10 wide, right? So that's what I do, and we'll look why, look at why I do that. Wider spreads provide a greater distance to the market. That's basically less risk, but it requires additional margin to spread out your positions. I always use 45 to 70 cents to gain when I decide on the premium that I'm going to use. It's usually around 55 or 60 cents. Take profit. You can do that. I do that 10 cents at times. But with the group I have, I trade, and I try to let it to go to expiration. Okay, just to not incur day trading processes. Okay, so you can also close the short strike. That's still, it gives you a better, or less cost, you know, for the premium, but it's still restricted to PDT restrictions. Okay, and expiration is the other one that you can use, and we do that a lot. All right, we just let it expire. When a trade is threatened, I would recommend for using a 2x or 3x short, you know, strike stop loss. That's preferred for bear spreads. I don't roll bear spreads anymore because you can really get into a lot of problems with rolling bear spreads, because in a market, you know, typically it goes up, and when volatility, you know, as the market's going up, volatility is going down, so it's much harder to adjust those trades. So now I just close the trades at 3x, you know, and just move on. Okay. The bull spreads or the put spreads I roll those trades, and they work out very well all the time, pretty much. And that's the preferred way to manage that trade when it goes against you. You can also roll the trade when it's in the money by widening it, the spread. You can send it out. You basically push it out for 1 or 2 days, but that's not recommended. You always want to roll a trade when you're out of the money, you know, before it gets in the money. Okay. All right. Okay. So here's the performance for 0DTE after I started changing my trade plan, and things worked out pretty well, except in November we had a couple losses, and May is doing pretty well as well. We just haven't updated that. So it's a consistent trade if you manage it well. And these are 1 contracts that I used, and then in August I used 5 contracts just to see how things would work, you know, in that period of time. And so during that period of time, I was really testing a change in my trade plan for 0DTE, and it's really worked out well. Okay, so I'm very confident with it, and you know, others that are trading with me are pretty darn confident as well. All right, so let's talk about why I use 10 wide. All right, so if you look at this chart here, you can see that if you're trading a 5 wide spread, okay, your call side is you know, 0.9%, like 1% from the market, and your put side is 1.2%. Now move over to 10 wide, okay, you can see it does change pretty dramatically. Okay, not so much for the call spread, but definitely for the put spread. And then if you go to 15 wide, it goes a little bit higher, but it's not really worth it to go 15, and that's why I made the decision a while back just to use 10 wide. Okay, the good thing about 5 wide is that when you do have to roll the position and widen it, you're actually doubling the position, doubling the width of that position, and so it really can push the market away from you for that, which is a good thing. Okay, so that's one of the benefits that 5 wide have. However, you're still very close to the market, and so you'd have more rolls or stop outs if you trade 5 wide. Okay, so now let's go to 20 wide, and you can see here this is actually 0DTE. Okay, this is so the difference between, let's go back here real quick. So the difference between a 22 VIX, all right, and a 27 VIX is quite a lot, right? So here you have, let's just look at the 10 here. You have 1.2, 1.7, and here you have 2.6 and 2.34 there percent. That's a very big difference, right? And so when it's lower volatility, trading 0DTE, it is harder to manage those trades. All right, so on this day we're at 1666, and we have fallen quite a bit. from that. Okay, and actually today I took a loss on the call spread, and actually I took one yesterday as well. And so when volatility gets lower, it's more dangerous. And so, however, even with the stop outs, over time, it's a fantastic trade, as you can see in the performance there. Okay, so those are with rolling, taking stops, et cetera, right? Okay, so this one I wanted to show you just the 20 wide here. That it's just not, it's not. It doesn't make any sense to trade 20 wide, and some people trade 30 wide and 50 wide, and it doesn't make any sense. But and I've known people that have gone back, to it as well. All right, so let's start looking at now these scenarios. Okay, so now we're looking at threatened trades. All right, so this is a position that that I'm using here, okay, where the market went down, right, and the trade was threatened, and the position that was put on was 35.75, 35.65, and you can see that it's in the money, right? So at that point there, your premium goes from basically like 50, cents to 245. All right, and that's why I'm saying when you roll the trade, you want to do it when it's out of the money. Okay, so then here, how you would roll that? In this case here, it's rolling using the same strikes. Okay, and so you would receive a 1.75 credit by doing that if you did it at the money, right? And again, it varies by volatility and the time of day, but this is kind of how it works, right? So same strikes for $1.75 credit. Let's go to the next one. We have a 41.50, 41.60 call now that's threatened, all right, and that's that premium now is $2.40, and when you roll that trade, with the same strikes, you're getting only $1.15, so it's much less than the put spread. Okay, and that's why I'm telling you it's more difficult to trade one of these the call sides. It's just more dangerous to manage. Same strikes, $1.15 credit. Okay, now we're going to the roll down into the next day. Okay, so we're actually rolling the position down into the next day. So same strikes here, 245, rolling down and receiving a 35-cent credit. So you can actually roll that down 25 points. Okay, now keep in mind, this was in a higher volatility environment. Today it would be like 10 or 15 points. Okay. So just keep that in mind. So, but you still get a 35-cent credit if you're rolling it close to the money there. All right. So here you have a bear spread rolled down to the next day. Got 240, and here, let's see here. Yeah, so you rolled up for 25 points for a 30-cent credit, basically. So this is wrong. It should be 30 cents here. So sorry about that. Okay, so the next one is bull spread rolled down, widened next day. And here, so the position is widened. So you can see here, it went from 10 wide, it went to 15 wide. So, and you were able to roll that down from 75 on the short strike to 30 cents. So that's quite a range, to get down to. So you basically rolled it 45 points for a 15-cent credit, okay, when you widen it. So you can see there, it gives you a lot of room, a lot more room than just using the same strikes and rolling it the next day, you know, by widening it. Okay, here we have a trade that, let's see here, 41.50, 41.60, and this one is rolled down and widened to the next day, and this is a bear spread, and you can see here that it rolled down, widened 25 points for a 35-cent credit. So again, more risk there. So this one here is rolling it out, same strikes, 2 days out, and here you can see that you receive $2.15 credit. So it's above. I think the other one was $100.75. So you get a little bit more credit for another day, and that's why I most of the time when I roll it out to the next day, just because you just get a better performance on it. Okay, so this one is the 2 days out. Okay. All right, now we're going to a bull spread, rolled down and widened, and 2 days. And so here you get a lot more room here. Basically, rolling down 2 days, you get 60 points for 35 cents. Okay. Are the slides moving now? Can you see them? Or is it slow? Okay. All right. All right. All right. So this one here is a bull spread, rolled down, widened 2 days. And let's see here. We got 15 cents. Okay. So we got 15 cents and we rolled it down. Let me see here. 245, 275. Okay, so yeah, it's widened, and it gives you a 15 cent position there, or a credit. Let's see here. Yeah. Okay, sorry about that. This is incorrect here. I should have looked at my slide. Okay, so the actual move down on this one is actually 100 points. And this one should have said, oh no, it's correct. I'm sorry. So this one is 35.75, 35.65 rolled down to 34.75, 34.60. I had my eyes crossed there. And it did it for 15 cents, and you got 100 points on this position. So that's a really good roll there, you know, if you had that. Okay, so now we're going to look at in the money bull spread. Okay, bull spread is using puts. So this one here, it's 35.90, and we're rolling it to, or same strikes, rolling it to the next day, and this one is actually in the money. Okay, now, and you can see here that the 35.90 was in the money. Market price was 35.80, and it's 10 points in the money. Okay, so now first of all, your premium went up to 610, which is really bad. Okay, that's a big loss. Okay, and rolling down the following day, you basically using the same strikes. You actually have to use a debit. So it's going to cost you to roll that trade. Okay, if it's in the money. So that's why you don't want to get in the money. Okay. All right. On the next one here, we sell the 35.90, 35.80. Again, it's this one's in the money, rolling it out the next day, right? So the next day, you get a $33.30 debit. Okay, it's even bigger. Is it bigger? It's bigger, right? It's bigger, much bigger. Okay, so this one gives you a $3.30 debit, and then you're behind the time here. So it's not fun when you get there. Hopefully, I am scaring you to tell you to always, if you're going to roll a trade, do it out of the money. Okay. All right. This one here rolled down and widened the next day. This one is in the money again. And this one you were able to move it down, and because you widened it, you're able to get basically a zero premium on the widened spread, and you're able to actually push it down. Okay. So widening trades is a good thing, you know, as long as you have the margin, and you're able to do that. All right, we're almost done with the charts here. Okay, so lowering the strikes 1 week out. This one you were able to, if you roll it and it is in the money, no, it's out of the money here, right? So it's 36.98. Oh no, there's a put spread. Yeah, it's out of the money, and so you're able to push it out basically quite a bit in order to get that position out there. So it's 36.90 down to 36.20. Excuse me. That's 70 points down, and for a 10-cent credit. So it's pretty good there to do that. So again, that's out of the money. Widen 1 week, and this one here, 36.90 down to 35.75. This one is 36.98. Okay, same thing, and you get a 15-cent credit for this one. Okay, widened out 1 week. Okay. All right. So now I'm going to show you just a couple trades that I did this week. Okay. And this is kind of the normal process that we use. Okay. So I wanted to show the good, the bad, and the ugly. Okay. And how we do this. And so in this case here, you can see here I put these two trades on pretty much at the same time. So I put on a 41.70, 41.80 call spread and a 41.10, 41.100 put spread. And at that point here, the market went down. I had to roll the trade, okay? And you can see where I rolled it. It was above, you know, so our position was at 41.10, 41.100, okay? And it was a little bit out of the money here, okay? So I was able to roll it. And on the next day, rolled it down to 40.95, 40.80, and the position expired worthless. And so the reason that the credit is higher is because when we rolled it, we actually got a credit for that trade, and then we closed it at $1. Okay, this is the ideal situation for when you're rolling a trade, right? So sometimes you have to roll it more than that, though. Okay, and here's going to be another example for that, and I'm going to walk you through this. Okay, so I put on this trade, and the positions were 41.85, 41.95, and 41.15, 41.05. And these trades here I put on within 2 minutes of the market opening. And so what happened? We had to roll the trade. You can see I rolled it again. The put spread was 40.15, 41.05. And I rolled it basically when it was around 41.20. Okay, so out of the money, I rolled a position. I got a credit. I was able to push it down. and I did widen the spread on this one, okay? And this is the case where volatility is lower, right? So now during this period of time, the volatility was in the 16 range. The other times that you were looking at on the other positions were in 27, 22, quite a bit different, right? So lower volatility, you don't have that. You don't have that kind of clearance. All right, so let's see what happens on this trade. All right. So the original position was, May 10th, and it was 41.15, 41.05. That was the original position that we sold. We rolled the trade. We rolled the trade from 41.15, 41.05, okay, and rolled it to 4100, 40.85. Now you can see here that this was a 10 wide, and now it's a 15 wide, okay? So we widened the trade because I wanted to push it down further, and we got a 30-cent credit. The next one is so the new position now we have a 4100, 40.85 for a 90-cent credit. So we added the 30 cents to the 60. Now we rolled it again because, even though the market was still above it, I wanted to still move it further down because I didn't know where the market was going to go. So when you have, when you're in the next day, right, you want to, and you're close to the money, you want to roll it again to get it further distance, and so you kind of de-risk the trade. Okay. So here I rolled the trade again using the same width in the trade, and we got a 15-cent credit. The new position is now 40.90, 40.75. So we went down 10 points here, and we have a credit now of $1.05. So we rolled the trade again. So this is the third roll that we did, and this time the market was higher, and I was able to push it way down. Okay, I pushed it 30 points down, and I said I want to get rid of this thing and say goodbye to it. And actually, the next day here, the new position is 130, and let's see here. We closed it at 10 cents, and the total credit that we received for that was $1.20. So remember, we started with 60 cents. We doubled the credit by rolling it, and that's kind of the work that you need to do if you want to, continue with your profits. Now, for those two trades, a lot of people just they take the loss, right? They take the loss. In this case, you're doing the opposite. You're actually working for it, and you're making an additional credit on that trade. Okay, this works really well with put spreads. It doesn't work great with call spreads. Okay, but at least you have a great chance of doing it with the put spreads. Okay, so real quick, I wanted to share with you just another trade plan that we use for options on futures. If you don't have a $25,000 account, this is a great alternative for you to use. And in this case, I did a webinar on the past couple of days. And I have it here, I have it in my YouTube channel as well, that you can use options on futures, a little more expensive, but margin requirements are lower in order to trade SPX and ES or to trade without having PDT restrictions. So real quick, the comparison overnight risk on SPX, there's overnight risk, none on ES because you're able to manage it overnight. Okay, the multipliers are different between the two, so that means you get half the credit for more. You need more legs, you need more contracts in order to get the same amount, and we'll look at that in a second. So greater margin requirement for SPX, less margin requirement for ES, ability to roll into later expirations for SPX. You can't do that with ES, all right? You have to close the trade and place it again. Cash settled for SPX, futures contract settled, and cash settled. So I don't want to get into the details of that, but if it's in the money and not out of the money, they'll assign you a futures contract. If it's completely out of the money, it's a max loss. They'll just it's a cash deal. Commissions and fees are less expensive for SPX, a little more on ES. Okay, so quick comparison here. You have the if you have the positions, one contract, right? Which is apples to apples. Remember the multiplier here, so you get actually a 55-cent credit instead of a $1.10 credit. Okay, so and you can see here that the margin requirements are much less for ES. Real quick, this is kind of apples to apples because you're using the same amount of premium. You cut this in half, it's 80 cents. But you're using two contracts. I'm sorry, not two contracts. You're widening the trade from 10 wide to 15 wide. Okay, and that's how you get the same amount of premium. The good thing is that it's only $2 additional premium for basically the same amount of credit. And the good part is that it's less margin. Okay, for using ES. All right, so this basically concludes the webinar for the options, the 0DTE options, and hopefully this was of great value to you. Okay, however, we have a bonus that I want to share with you. Okay, and the question is, would you like to follow our trades while you learn using our short-term strategies that I've outlined here? Right, and of course you can basically earn while you learn. Okay, so we talked about being interested in learning new strategies, desire to see your account grow month after month, and find the right strategy that results in those consistent results. Well, what you have to do is you have to break those barriers. Okay, and I've been there a lot of times, and so you want to get to a place where what you're doing, is it what you're supposed to be doing? Is it going to stick, or will you finally find those steps, to get there that makes it really, really work for you? Okay. In addition to that, you have to have a no quit attitude. You have to be committed to what you do and disciplined, and you have to have an edge. Now, that's the same thing in having a career, right? If you're gonna trade, you have to have that edge, or else, it's the 20-80 rule. 20% of the people are going to make the money and 80% are not. But if you focus and you really discipline yourself and commit yourself, you can make money. I mean, you can definitely make money. All right. So we have trade alerts, and these come directly from my account for the most part. We have other traders that we trade with as well, but these are very, very automated, and you get the right signal at the right time. Okay. The thing is that if you're a great trader already, it's a great place to enhance your trading. If you're still beginning or in the middle there, it's also a great place for you to learn. We're doing a lot of things now to enhance it. We're going to have webinars weekly on the trades that we do, and really try to educate the traders that come in with us. It's just a great environment to be in. It really, really is, and I'm really proud of it. And we do have a guarantee as well. And so we have these chat channels that are two-way communications. Okay, so one of them is restricted to just the trade, just saying, hey, I'm in this trade, what do I need to do, blah, blah, blah. And that's just restricted to that conversation. Okay, we have another area that you can talk about anything, but in this case, you know, we want to make sure that the conversation is about the trades. Then we have one-way communication on these. So these are the trade signals that come out. So in these, we really protect to make sure that everything is very, very accurate. And you know, one of the first things I did in the first year of the trade alert service is we automated the signal, so to make sure that, because I was writing them down and you know, trying to get it right, and sometimes, you know, you have to do it really fast, but these come out automatically from my account, and they show up within 15, 30 seconds, and sometimes it's even less. So great, you know, great success stories that we have, that, you know, that you can look at real quick. Okay, these are people that just really love the service and have been with us for a very long time. Actually, this Dale has actually been with us for about 4 months. He started with an account with 3,000, you know, and I said, hey, the minimum you can have is 3,000. The guy took it up to 31,000, and he's doing great. All he does is 0DTE. I mean, that's all he does. Okay, so he's very, very focused in what he's doing, and he's a great trader. So I also have a guarantee. So if you're subscribed for 1 month and lose money by following my trades, okay, I will refund your subscription by 125 points. And I actually have never gone bad with that, or done good with that. You know, I've never had to pay someone back for the subscription. Okay, so that's our guarantee to you. And if it happens one day, I will pay you back. Okay, so now I want to share with you an offer. Okay, so let's put the offer up here, and let's see. Okay. All right. So, so in that offer, we are going to be closing our subscription for another 3 months. Okay, and we do this because we want to focus on the traders. We get a lot of people coming in at the during the subscription open process, and what we want to do is make sure that we answer all the questions. Make sure they're understanding what's going on, because there's a lot going on in there. And I always tell people when they come in, hey, you know, focus on one trade first, and then, you know, go to the next. We have a lot of different trades that are high probability trades. Okay, and we have 3 or 4 traders that do their own trades as well. Okay, so the normal pricing is $59.99 to $129, and you can see here what you get. All right. The first one for $39, the discounted rate, the monthly expiration, that's monthly AM expiration. That's how I trade. That's how I started trading credit spreads. Okay, using SPX. You get subscriber trade alerts, and then we have a lot, you know, full-time traders in there that make their own trades. Okay, and they're darn good trades. Okay, the traders chat, the traders education portal, the guarantee, and the $20 rebate for life. Okay, the second one is $79. You get that from the swing trader. You have 0DTE and 7DTE and premium trades. Okay, and Ike is a machine. He puts on diagonals and calendars, and I mean a lot of these trades, and he's been doing this for a very long time, and he's a great trader. And then we have the 109 plan, and that's for futures traders, options on futures, and we have live rooms open every single day. Okay, from 10 to 4 o'clock, and then on Monday, Wednesday, and Friday, I actually open up the 0DTE room for placing the trade. Okay, that we go through that, and we place the 0DTE trades. Okay, so. So if this is for you, okay, you want to learn a step-by-step process to gain income in a market that goes up and down, and you want to finally break those series of losses, okay, that we've all had, this is the place to come. Okay, you're able to earn consistent income, and it will set you apart, I promise you, from all the other traders that are losing money. So 20% off if you subscribe, okay, and we're normally we have the wait list open, but right now we're actually open. We're going to be closing on Sunday. Okay, the price is going to go up to the normal price in the next 3 hours, and you'll be able to get that bonus forever. Once you get in, okay, and you want to upgrade or downgrade, we'll keep the same discount, and you can do that as many times as you want. All right, and we've done that with many traders. A lot of times they come in and they want to start at the 79, and then they upgrade to the 109. Okay, we have a training education portal, and we're going to revamp that one coming very soon, because now we're going to be starting weekly webinars in there about our trades, so that everyone is acclimated to that process. Automated signals is what I mentioned: trade entry, fill price, target after fill, and my guarantee. And also we help you manage the rolls as well. Okay, and they're very, very clear when they come out. In fact, we made 2 or 3 rolls today on positions, and it was very, very smooth that it went through. You have a winning strategy, guys. All right. So let's get back to the questions here. Hey Chip, the alerts are pretty good. I have been following Al's. Hey, thanks Chip, appreciate it. Count is up over 4,000. Awesome. As a new active member, hey, wow, man. Okay, I did not pay these guys, I promise you. No brainer. Thanks, Kay. I really appreciate that. All right. Any questions here? Let's see. When exactly would you roll a threatened put spread? 2x loss, 3x loss, deltas, points away from in them. Okay, great question, James. I rolled it. I try to get within 15 to 10 points away from the market, or away, being out of the money, and that's when I roll the put spread. In the case of a call spread, I try to use 2x, and today the market went really fast, and I had to use a 3x loss there. Okay, the deltas for the most part, when we put those on, those are like 6 to 8 delta for the premiums that we get. And let me see, points away. Okay, I think I answered all your questions there. All right, let me look at the Q&A. Is there a subscription for futures only? Not for futures only, but you get everything else and futures. All right, it's kind of the whole thing. Okay, love the fact that we live on Voice and open 0DTE. Thank you for that. Okay, great. This is recorded. How do you calculate capital requirements? Cash margin for every one contract. I have a guideline that I can share with you. We have to put that out there, but I will get it to you. Okay. And Kay, are you in our trade alert service, or is it a different Kay? Okay. Let me see. Kay. Yes, Kay, you are new. You are a member. Okay, yeah, I'll send you the capital requirements that were just modified about 2 months ago. Let me see here. What else? Okay, I think that's it. Any other questions that you guys may have? Man, we're finished for 5 minutes early. Okay, great. Yes. Michael, I'm going to be updating. We do have an educational portal that you get automatically when you join. And I'm going to be updating that in the next 2 days because we're going to be putting a lot of stuff in there that's really, really powerful. Can I show the different plans? Absolutely. Let me take you back. There's an offer that you should be able to see them, but let me take you back there. Here we go. There you go. I missed the question. Hey, sorry about that. Let me look. What are the deltas? Trade 0DTE, better question, delta. Yeah, the deltas, when we put on 0DTE, it's about 6 to 8 delta, 0.06 to 0.08 Okay. Any other questions? All right, guys. Thank you very, very much for sticking with us here. And like I said, in the next 3 hours, we're open at the discounted rate, and then we're going to be raising the price again. And then on Sunday, we're actually closing, and you won't be able to get in for 3 months. And again, we do that just because we focus on those 3 months on the traders, and when they come in, they're asking a lot of questions, and we answer all those questions. And then we go to the serious stuff by our trading. Okay. All right. So thanks again. And where do you place? Oh, I don't place at the money trades. I don't. I know some people do, but I don't. Okay. Thanks, guys. We'll see you again another time. Thanks again. Bye.